Welcome back to Beyond the Benchmark. I'm Ryan Kasper. This past week brought a fairly full slate of economic data. And while inflation remains sticky, the broader picture continues to suggest an economy that's slowing in an orderly way rather than breaking. Consumer price inflation came in largely as expected in December, with headline CPI rising 0.3% and core inflation up 0.2. Year over year, inflation remains elevated at roughly 2.5 to 3%, but importantly, it's not re-accelerating. Shelter costs and select services remain the biggest contributors, while several categories like used cars and household furnishings continued to ease. Producer prices told a similar story, with modest gains and year-over-year inflation still running near 3%. The takeaway from both reports is that inflation pressures persist, but they're becoming more concentrated and less broad-based. On the growth side, the data leaned more constructive. Industrial production rose 0.4% in December, driven by strength in business equipment and high-tech manufacturing, tied to ongoing investment in semiconductors and AI infrastructure. Retail sales also surprised to the upside, with a strong rebound in November as autos, apparel, and holiday-related categories picked up. On a year-over-year basis, consumer spending continues to grow slightly faster than inflation, reinforcing the theme of a resilient but more selective consumer. Housing data was mixed but showed some encouraging signs. Existing home sales rose over 5% in December, marking the strongest pace in nearly 3 years, helped by lower mortgage rates and easing price pressures. New home sales also moved higher, and affordability is improving modestly as mortgage rates have fallen to the lowest levels in several years. That said, builder sentiment continued to weaken, as high financing costs and cautious buyers keep pressure on activity despite improving sales data. The labor market remains steady. Initial jobless claims fell below 200,000, and continuing claims declined as well, reflecting normalization after year-end seasonal distortions. While hiring has slowed, there's still little evidence of a meaningful rise in layoffs, which remains an important support for consumer spending. Markets responded positively overall. Equities around the world advanced last week, with small-cap stocks and international markets outperforming large-cap U.S. equities. Bonds, on the other hand, lost ground as interest rates ticked higher in response to persistent inflation readings. Commodities were mixed, with precious metals continuing to lead amid heightened geopolitical uncertainty, while energy prices moved higher on renewed tensions in the Middle East. So the takeaway this week is fairly straightforward. Inflation remains sticky but contained. Growth is moderating, not stalling, and markets are broadening beyond U.S. large-cap leadership. As we move deeper into 2026, diversification and balance remain key themes as investors navigate inflation, policy uncertainty, and global risks. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. We appreciate your partnership, and we'll see you next week.